Hey guys, welcome to my channel, Stock Compounder. My name is Brad, and today I want to talk about how Mohnish Pabrai suggests to improve your results using the magic formula investing strategy from Joel Greenblatt. So I just want to read a quick excerpt from the Dhandho Investor about how to do this. So Mohnish Pabrai, his whole thing is finding 50-cent dollar bills. So it's finding companies where you can spend 50 cents today buying stock, and then in 2 or 3 years, that stock will be worth $1. So, he likes the magic formula a lot. But he's got a tip in his book, The Dhandho Investor, on how to potentially improve it. So here, I'll read this. The Value Investors Club website is open to the public, and it is loaded with a plethora of 50-cent dollars. Anyone can view these write-ups on individual stocks on www.valueinvestorsclub.com. This website was also created by Joel Greenblatt. About 250 good investors post 2 to 4 of their best ideas every year. Greenblatt awards $5,000 to the best idea each week. The website costs him $260,000 plus maintenance costs to operate and seemingly generates no revenue. Greenblatt has described the website as American Idol for hedge fund managers. He basically uses the website to find promising money managers, seeds them with some money, and puts them into business. So he makes millions of dollars a year by seeding these great investors. If an investor just analyzed stocks that are on the magic formula and have a VIC write-up, they're likely to do quite well. So that sounds like an awesome tip. So here's what I'm doing here. This is the magic formula investing site. You can see I pulled a screen based on companies that are over 50 million in market cap, and I pulled 50 companies. So what I did here, just to see how many of these have a write-up in Value Investors Club, I copied these over to a spreadsheet, and then I searched for each one. You can search the ticker in here in Value Investors Club, and you can see if there was a write-up, and if there was, when it happened. So the most recent write-up for Allison Transmission Holdings is 4/25/2018. So what I did was I plugged that into my spreadsheet. Right here you could see it's between 2 and 3 years old. So I went through and I looked at all of these 50, and I found that there were 24 that had a write-up within the last 3 years. Okay, 8 of those have had a write-up in the last year, in the last 12 months. So, this would be a great place to start if I'm looking to implement the magic formula investment approach. How do you select, which ones you buy in your magic formula portfolio? Well, I think a great place to narrow that list down would be, if you were just going to buy it without any further research, I would be buying these 8, the 8 that have the most recent write-ups in Value Investors Club. Now, if you want to do more research than that, you certainly can. You can actually read, the report in Value Investors Club. So I can pull up this latest report, and I can see, what the investment thesis is, how much they think, this company is going to return, and over what period of time. So you can certainly dive into that. And I also want to share a few other potential ways to narrow the criteria even more. Because the magic formula is great for providing a starting list of companies, but we can, add a lot more complexity, add a lot more nuance to these specific companies in terms of what we're looking at. And I want to give a shout out to this book here, 100 Baggers, Stocks that Return 100 to 1 and How to Find Them. The author is Chris Meyer. So he basically did a study where he looked at companies that returned 100 to 1 between the year of 1962 and 2014. So over that, what is that? 52-year period. He found 365 companies that were 100 baggers over that period. Now, there were some commonalities with these 100 baggers. And so a few of them, he found that the median market cap of companies that turned into 100 baggers, returned 100 to 1, was around $500 million. So, one way you could apply that to the magic formula screen is you can say, okay, I'm only interested in companies with a market cap between, say, 50 million, which you can't go lower than 50 million in the magic formula screener, up to, say, $1 billion. And the assumption there is that as you get larger as a company, there's a cap more quickly on how big you can grow. Like take Apple, for example. If you're thinking Apple is going to grow 100 times from now, with a market cap around $1 trillion, I mean, they'd have to have 100 trillion market cap, and that's just not going to happen. So, it helps to focus on these smaller size businesses. If you're trying to find companies that are going to, generate 100x return while you hold them. The average time to getting to 100x for these 100 baggers, it took 26 years on average for these companies to generate 100x return. 26 years. And as we all know, the magic formula has you buying and then selling a year later, assuming that the company is no longer on the screen. If it's on the screen, then you would hold it for another year. But really, it's a kind of a 1 year and then reset approach. So, this idea of holding something for 26 years, doesn't really fit in to the magic formula approach. Of course, we get to decide how we implement the approach. So, if you wanted to do more of a coffee can approach where you're buying these companies and then you're just, the old coffee can idea for investing was you buy stocks, you stick them in a coffee can and you forget about them for 30 or 40 years and don't even think about them. And, that's a compelling way to give these investment ideas time to really achieve their full potential. So that's one idea, is to extend the holding time, if that makes sense for your approach. A few other things that had some commonalities with 100 baggers, management having a meaningful stake in the company, or owner operators, companies where, a large part of how management is compensated is through, equity shares of stock or stock options, where, a lot of managers just get paid an annual salary and they don't have a lot of skin in the game in terms of the equity holders, receiving the benefits of, a growing company. So it's important that management has aligned interests with equity holders. And one of the ways to make sure that that's more aligned is to look for management that has a high, ownership stake in the company. And then one other thing I want to put in here is when Mohnish Pabrai was creating his investment checklist, he did a lot of research on great investors and what investments they had made that failed. investments that didn't work out. What were some of the commonalities between those investments that didn't work out? And one of the biggest ones, actually the biggest one, was companies that used a lot of leverage, companies that had a lot of debt, and they were using debt to grow. And when you do that, that can work great when times are good, when the market is going up. But when the market isn't doing so great, that's when you get into big trouble if you have a lot of debt and you get knocked out of the game. You go into bankruptcy, the company disappears. So, another thing that I think would be great to incorporate into this this screener, the magic formula, is not only looking at Value Investors Club write-ups, but looking at how much debt the company has. And one great place to do that is this website, Magic Diligence. Now, Magic Diligence was created out of the idea of the magic formula from Joel Greenblatt. So essentially what Magic Diligence does is it attempts to give you the actual numbers behind the magic formula screener, because Joel Greenblatt doesn't give you what the earnings yield is, what the return on invested capital is. He just gives you the list, doesn't show you the numbers underneath. And so this website aims to show you the numbers underneath and give some additional numbers that might be relevant. So the first result here on the magic formula screen, Allison Transmission Holdings. So I looked that up in Magic Diligence. You can see what the earnings yield is. You can see what the return on invested capital is. Those are great numbers there. You can also see the current ratio. Now, current ratio is current assets divided by current liabilities. And it's really a measure of the ability for a company to cover its short-term liabilities. Now, anything over 1.2 is considered pretty healthy. So, that's another way that you could, narrow this list. If you're looking at these 8 companies on the magic formula screen that have a write-up on VIC over the last year, a few of them are going to have really bad current ratios, below 1 or even below 1.2. So that's a way, if you want to, if it kind of makes sense for the approach, for your kind of hybrid approach with the magic formula, you could remove those companies that have too much debt or are too leveraged. And that would be a number to look at to get rid of those companies. The last thing I want to share about this is, another hybrid approach is to look at magic formula stocks, but also look for companies that super investors have invested in recently. I don't have that website up at the moment, but I can pull that up. I like Dataroma for that. So you would look for companies that are on the magic formula screen and companies that have recently been purchased by, this list of super investors. And you can look at top 10 buys over the last quarter or 6 months. Compare that, see if there's any of those on the magic formula screen. Now, I know that GraphTech here, EAF, was bought not too long ago by Mohnish Pabrai at a price that was higher than what it is now. It's near its all-time low right now. I think it stopped trading today at $6.75 per share. I think Mohnish probably picked it up around $9 or closer to $10 per share. So that's a company I would definitely recommend diving into if you're looking for these 50-cent dollars. So another thing, if you're looking to do the shameless cloning, if you're implementing this, companies that are both on magic formula and have been bought recently by a super investor, just make sure you understand what that super investor's investment philosophy is. When did they buy it? What price range did they buy it in. You could tell, what the price range was in the quarter when they bought the company. And what percentage of their portfolio is that company? How high of a conviction do they have about that company being a good investment? If someone bought it, but it's like a 2% bet, that wouldn't be nearly as compelling as if, you have someone like Mohnish Pabrai buy it and it's, 10% of his portfolio. So those are some things to look at there. And I think that's a pretty good overview, guys. I really like the magic formula, but I think there's a lot of value in, using a couple more criteria to narrow the list down and, buy companies that have an even greater chance of doing well for your portfolio over time. And I think, some of these metrics that I shared are some of the best. And I highly recommend, like I mentioned before, devouring this book, 100 Baggers. If you can find just a couple 100 baggers in your portfolio, I mean, it works wonders for your returns over time. It's a fantastic read, so check that out. All right, guys, I think that's all I got. Just wanted to share, how Mohnish Pabrai would kind of tweak the magic formula investing strategy. I think there's so much value to be gained by just these little tweaks. So curious to hear from you. Let me know what you think of all this. If you are implementing the magic formula investing approach, and which of these tweaks you're excited to implement as you go forward. All right, guys, have a great day. I'll see you in the next video.